And we're going to talk about money. So hopefully all of you are interested in money. Now, as we talked this morning, there's a real challenge and a bridge between the people who have resources and what we heard this morning reflected in the frustration and the issue around matching those resources to the folks who have the motivation and who are actually have the capabilities to make urban entrepreneurship a reality. So that's certainly some of the discussion we'll have today. I'm sort of playing that stabler's role. I don't have this deep voice, but I'm part moderator, part panelist. So we're gonna go through real quick, and we're gonna do a introduction of all the panelists who are here today, who we are, our organizations, just 2 to 3 minutes. But also, I think really important is talk about how we define urban entrepreneurship. But before we do that, I think for all of us here, it's really helpful to know who you are. So if we could just get a quick vote on how many of you are entrepreneurs in the room. Okay, great. And how many are students? All right. How many government, academic folks? Okay, corporations? Okay, we got a real balance here. Did I leave anything out important? Nonprofits? Okay, great. So a real balance here, and that helps us, so we appreciate it. So we're going to start with our out-of-town guest, Lein, and she will give us a brief intro.
Hey everyone, my name is Julie. I'm the co-founder of Tumml. We are an urban ventures accelerator, and what that means is we support early-stage businesses that are making an impact in our cities and looking to scale that impact. So we work with entrepreneurs at a very early stage. We help them get off the ground with $20,000 in seed funding, mentorship, a free office space in downtown San Francisco, and an education curriculum that's designed to help entrepreneurs grow their businesses and scale their impact to communities all over the U.S. and beyond.
Good afternoon. My name is Neal. I'm one of the founders and managing directors of Michigan eLab. We're an early stage venture fund located both in Ann Arbor and in Silicon Valley. And I've had the pleasure of being on both sides of the table throughout my career, started 5 companies. So as both an entrepreneur and now as a venture capitalist, I'm happy to talk to you about what is attractive to us when we're looking to invest in a company. But we take over on the financing stage right after an organization like Julie. We would invest $250,000 up to $1 million into early stage company.
And I'm Ray Waters with the Detroit Development Fund. We are an economic development fund that have been in the city for, I started in 2003. We started with $1 million to lend into the market. Over the last 7 years, we've lent $37 million into the market, 95% of that to Detroit companies. Out of our small business lending, 80% of our lending goes to minority-owned companies. Our companies in the last 4 years have created close to 1,500 jobs, the ones we finance. And we also have a real estate arm that lends to organizations and developers who are buying and rehabbing abandoned homes and abandoned multifamily units. We think that's an important piece of Detroit's recovery. And our organizations have been fortunate enough to bring back close to 1,500 or 1,600 units that were abandoned before. We are a loan fund. We're not an investment fund. But I should tell you that just recently we formed what's called the Detroit Microloan Fund Collaborative. Consists of Detroit Development Fund that we can loan $40,000 and up, the Michigan Women's Foundation, the Detroit Micro Enterprise Fund, and Lifeline Business Consulting. We began in earnest last November, and by the end of this November, the collaborative will have closed 32 loans for $1.1 million, and of those 32 loans, 10 of them were startup companies. We see mostly lifestyle companies. We don't see high-tech companies a lot, but that's kind of our niche, and that's the sandbox that we play in here in Detroit.
All right, and I'm Glaza, and I'm with Invest Detroit. Invest Detroit has a family of 9 funds. We do real estate and commercial lending. I run the venture team. I run 2 early stage venture funds focused primarily on high tech. We have over 80 investments in the state. The majority and we look across a broad range of technologies and stage of formation. So we usually deal with early stage folks going through sort of the early A stage. And we can talk more about some of those funding stages as we go through. So why don't we start, and why don't we talk about, Julie, why don't you start with what typically does a company, when they come into your accelerator, what type of funding have they already secured?
So when coming into an accelerator program, and many of you have probably seen there's been a proliferation of accelerator programs. Tumml is the only one focused on urban impact, which is probably why I'm here today. But what we really care about are urban-based businesses, meaning you're making a huge impact on your community, and you're looking to scale that impact from city to city. To date, I should note we've supported 33 startups. They've gone on to raise over $35 million in follow-on funding. They've created 280 jobs, and they've touched the lives of 2.2 million people in 69 urban areas. So just a quick stat overview, since I felt like everyone else had pretty good stats. I would say that we usually are the first funders in the door when it comes to an early stage company. So some of our companies will have bootstrapped a little bit, maybe some friends and family funding, but we're generally the first outside capital in the door. And where we see our niche really playing is helping extend an entrepreneur's runway through our program and really getting them to that next level of financing. And typically that next level of financing comes in the form of where Doug would play with an angel or micro VC round. And maybe Doug, you can just jump in and talk a little bit about those terms. But typically that's what we see. So if you're early stage and you're looking for financing, come talk to me.
So this morning though, before we jump to Doug, before you go out for real outside funding, there's 4 primary folks that you go to for initial funding. That's family, friends, fools, and the last one, most importantly, is founders. So would any of you like to kind of comment about one of those 4 and why that's so important to have one of those 4 in before you even hit an accelerator program?
Well, sure. When I started my second company, definitely hit 2 of the 4 F's in that: friends, family, fools, founders, and family. It's really important for other investors to see that you have skin in the game. Bottom line, that's where the founders' investment is. So if you're not willing to put some of your own money in, why should we put our money in, right? So that's the first thing. But the second dynamic of family is a very interesting dynamic, and you have to be really thoughtful about whether you take that money. It's one thing to lose your money, it's another to lose your parents' money or your uncle's money. And it can be a big stress, of course, at family reunions and Thanksgiving. So it's a challenge. But what I found too, it makes you work harder, because I actually was more concerned about losing my uncle's money when I started one of my companies than just my own money. So, but it's as Patty said, there's these multiple sources of early capital, and each has its pros and cons.
Ray, how many folks have that initial funding before they come to
Yeah, when we look at a company, particularly if it's a startup company, but even those that have been in business for a couple of years, we really do like to see that the owner has some equity in his company, whether it comes directly from them or family, because that does give us a sense of commitment on a financial commitment of the owner, and becomes pretty important to us as we go forward. We don't have a set amount that we use depending on the size of the loan, but that does become important. We don't see a lot of companies that have angel funding because, as I said, most of our companies tend to be lifestyle companies. They're not going to have an IPO in the next 3 or 4 years or probably be bought by anybody. But that money from the owner becomes really important as we look through it.
And we talk about fools, and we say that slightly jokingly, but it's really important that as you're taking money from non-friends and family in that early stage, is understanding that this is really high risk dollars. The person putting money into your business should be putting it's almost like a gamble, right? It shouldn't be money that they need for their retirement or for their kids' educational savings. This is money that they can expend because they believe in your vision, they believe in you, but they're not expecting that money back. Now you need to be firm about getting that money back. But again, it's that person who has the capacity to help you fund your vision. But again, it's the highest risk dollars into the company. So now Doug, kind of transitioning into the stage where, sort of this early stage where they may or may not have gone through an accelerator program, they might have an angel or two. What are some of the things that you really look for as a company transitions?
Right, and before I answer that, can I make sure, I want to follow up on something Ray said about lifestyle companies. Does everybody know what a lifestyle company is? Raise your hand if you do. I think it's really good we have a terminology understanding. So what we're referring to really is companies that are good companies that can grow and can provide a person a lifestyle for as long as they want to do it, and will have a moderate growth trajectory. In fact, a majority of businesses in the country, these are lifestyle businesses, right? And they're great businesses. And it's just a different type of business that you would take to a venture capitalist, which is what Patty asked me to talk about. Because when you take equity investment, which can be from an accelerator or early stage funds, we are investing in you to get a return, and our investors want a return. In order to get that return, there's really only two ways it can happen. You can either IPO the company, become a public company, so the stock can be traded, or you can sell your company. But one of those two things are going to happen. Lifestyle companies aren't on that trajectory, right? And you can continue to run that lifestyle company forever. But venture or equity invested companies, there's an exit at some point in your future. So that's a decision as an entrepreneur you need to determine, is that right for you? And a very small number actually of companies receive venture financing, so it's not the only path by any means, and we can talk about that. But so back to your question, when we look at investing, we're looking for, we have a lot of check marks we have to cross, but there's some basic things we look for. One, are the founders addressing a really big problem in the world? A problem that is very, affects a large number of people, has a big market. Secondly, is the team fully dedicated, and have they proven out the model in some way? Have they proven that they can attract customers and sell product or services to meet those customers' needs, and have a good use of capital to scale their business, right? And then I guess the third thing would be about how unique the opportunity is, how technically difficult is it, why this team and nobody else. And then we get into more aspects that are secondary, such as the quality of the team, the interaction of the team, the protection of the IP, and stuff like that.
So Ray, when you look, maybe spend a little time talking about how your microloan program is different and why that would be applicable to more lifestyle businesses. And again, when we say lifestyle versus tech, there is no judgment. They are both extremely valuable and critical to the ecosystem. But this is just showing that there are different paths to how you would fund them. So maybe talk about some of the criteria that you use.
And not every business should start with a loan. I mean, sometimes it's not going to grow far enough, fast enough to pay back. One of the things that we've done with the Microloan Collaborative, this is what we found over the last 5 or 6 years, and it's proven even more correct at the Microloan Collaborative that we formed. Most of the companies that come to us aren't ready for a loan. They don't have their business plan, they don't have their financial projections, and they don't have their market stage. It's probably true with some companies that come in first stage too. It's critically important when you get in front of us that you're closer to being ready for a loan. So we formed kind of a portal with Lifeline Business Consulting, and companies can start there if they're startup companies, and they'll help them do a business plan and financial projections and all of that. And so when they come to us in front of the collaborative or to us directly, they're much more loan ready. And that's really an important piece of the puzzle, rather than walk in without financials or walk in without a good strategic plan or a business plan, because we'd like to see that it's been thought out. Some of the loans that they've done, as I said, are to startups. Of the 32, 26 are women-owned companies. And my favorite is a young lady who went through the Lifeline program twice. She wanted to do something that I thought was kind of silly, but we said, let's see what happens. She bought a hot dog cart. She wanted to sell hot dogs at events and sell hot dogs around town. And so she went to the program twice, and when she got in front of us, she was so darn ready. Her presentation was on target, and you could just tell she had this drive and perseverance. So the Michigan Women's Foundation, through us, loaned her $12,000. She's going to do $45,000 in sales this year, and she had a net worth of $500. So it can be done. I'm fond of saying I've started two companies and grown them and sold them too. I'm not really fond of the word entrepreneur, and I'm even though this is named that, because what it really is drive and perseverance and hard work. And if you've got that, you can do it. But if you don't have those, there are a lot of companies that come to the collaborative and just decide they don't want to start a business. That's great. That's a success too. I'd rather have that happen than have them start and fail. But whoever you talk to, just be sure that you're prepared with a good story and some good financial projections.
You know, it's a really important point that rarely is a funding agency ready to hand out dollars the first time they need you. So I know at Invest Detroit, typically with our funds, we meet entrepreneur, we work with them sometimes directly with assistance, sometimes others we pass to other programs. There are a lot of great resources here in the region between Tech Town and Spark and some of the other Macomb Incubator, OU programs. But maybe as a panel, I'll talk about sort of our average time. Our average time is probably between 6 to 9 months before an organization is truly ready for raising an initial round of funding.
Our average time is about 2 to 3 weeks. Obviously that's very fast, but again, we're an accelerator program, so we will do a really hardcore selection process for about a month where we'll get written applications and we'll go through a multi-round interview process. People generally here within 3 weeks, and then they come out for the program.
Do people come back that haven't made it the first time?
They do, and I love to see that. I think that perseverance story is a great one to see, and I can't emphasize the importance of showing some early traction, because I think too often people get really infatuated with the idea. Oh, I have this brilliant idea, I can't wait to share it with the world. But in actuality, it's more impressive to see some early traction. So for example, even if you don't have the full tech built out, are you talking to potential customers? Have you done some use case studies? Have you gone out and tried to pilot your product even without the full tech? I think those kind of things can be really important and compelling to us, because we don't expect you to have the world figured out, but we do expect you to have a plan to get there.
Any additional comments?
No, those are all great comments. I was enjoying that. Going from what Ray said to what Patty and Julie said, you can't underscore enough this passion that the entrepreneur has to have for the company they're working on. And we characterize this characteristic of a smart entrepreneur really in the behaviors that Julie was talking about, that they're out there hustling, gathering data, talking to customers, developing hypotheses and testing those hypotheses. And you can do that with paper and pencil. You don't need to build the tech. I'll give you one example. I was working with some entrepreneurs who were building a drone technology. This is back before we had drones, so this is like 5, 6 years ago. And they wanted to use it to fly over farms and take infrared photos of the fields to give data to the farmers. That was their vision. And they had put together some money to develop the technology, and they were going to build their first prototype drone. And they were taking months. And I asked them, if you had to deliver this service to a customer this weekend, how would you do it? And that's an interesting thought experiment that you go through. But we use it as a way of testing the creativity of the entrepreneur and their commitment to the idea. And in this case, they said, well, I guess we could rent a plane, fly over the field, lean out the window, and take a picture. And that's what they did. And there's an easy way to gather data without building the drone to test the idea. And that passion, that commitment, that hustle means a lot to an investor to show how committed you are to figuring out a way to move forward. Because a lot of what we're doing is we're trying to fund you to move forward, but you have to figure it out, right? And so we like that creativity.
Just like the entrepreneurs and the folks supporting the entrepreneurs in the room are always looking for new ways to, new businesses, new concepts, ways to disrupt the market. Also from a funding perspective, we're also always on the look for how do we do this better? How do we better meet the needs of our communities? How do we make sure that as many good businesses are getting started as possible? I know David wanted us to we'll move to questions in just a sec, but I just want to quickly bring up the idea of crowdsourcing. Certainly a very popular method of getting companies launched today, or at least in theory, and we get asked about that all the time from companies who walk through our door. So I want to just briefly throw it out to the panel to get their thoughts on when is it appropriate, how much success are they seeing it for companies, and in what way is it being truly used today?
I mean, I would throw out that we've seen two different types of crowdsourcing. One is the actual crowdsourcing from sites like Kickstarter and Indiegogo and others, where you actually put a product out there and you essentially use it as a gauge for the market to basically test out your product and actually get sales for your product. And that's actually been very successful for our entrepreneurs with a physical product or a technical product that they can actually sell. So we've actually seen a lot of success in that, and I think it could be great for marketing. On the other side, we've also seen entrepreneurs use crowd investment tools like AngelList, where you can essentially solicit investment off of a pooled group of angel and venture capital investors. And that's also been successful for our entrepreneurs, but I think that they're two kind of very different use cases. So if you think about going in the crowdsourcing, crowd investing space, just do your homework, because to be successful, you have to put in a ton of prep time and you can't half-ass it.
Yeah, it's not about putting a picture on a website and hoping people are going to come. There's a lot of thousands of dollars that are invested in the marketing that goes around to support it. Doug, do you have any other?
I'll just add on top of that is in the, we made a launch on, let me back up. Crowdsourcing for Kickstarter for product development has been a great way for people who are building physical products to reduce the time it is to get them to a prototype level or product. In the software space, that's become available through tools that are online, but we've been missing that same kind of acceleration for the early stage entrepreneur that Kickstarter provides. The problem it runs into is, I run into entrepreneurs all the time that have done a successful Kickstarter campaign and raised thousands and thousands of dollars, and they're like, this is amazing, everyone loves this product, it's going to be terrific. But the Kickstarter validation, is, as I think Julie was talking about, is really a validation of the marketing ability of the founding team. It's not a validation they have a great product. Okay? So it's a great way to get some cash in the company that's not dilutive usually. But it's not necessarily, we don't look at it as a signal of validation, it's a signal of how good a marketer you are, right? And so it's just a different approach.
And how good of a hustler you are.
How good a hustler, that's right. Hustler in a good way.
Which says something. Yep. We've seen several companies not only do the microloan fund, but Kiva is here in town, and we've seen several companies here in Detroit be able to do a $5,000, it's a zero interest loan for Kiva, and that's a little validation of a company also. I'll give you one quick warning, this is off the subject, but something we've seen more and more of in the last 3 or 4 months. We've had companies come to us, there are now loans that you can get online, and it's easy to do. You just apply, they can turn around and say yes in 24 or 48 hours, depending on the circumstance. But this is what you have to be careful of. 2 of the companies that come to us have taken out loans for $50,000 and $60,000. The company has access to the bank account. They deduct money every day from the bank account, and the interest rate annualized on these loans is between 30 and 48%. So if you're thinking about doing that, be very careful, because we couldn't help that company. We tried like heck, but we couldn't do it until they paid it down. We had one that paid it down to 20. We loaned them the money to pay it off and said, please don't do this again. So I just warn you that it's something we're seeing more and more of.
All right, so let's take questions from the audience.
Yeah. Now that's a great question. It's amazing how often you'll talk to investors and they'll say, I love what you're doing. Come back to me when you have more money in. And I'm like, well, if you don't put money in, how am I going to get more money? I think it's a famous chicken and the egg issue. This is why I co-founded Tumml, basically to help entrepreneurs and to be comfortable with allocating risk capital to be the first funders in the door. So blatantly, that is the purpose and mission of Tumml. And I should note, we are a nonprofit organization, so that is very much our mission. What I would say is, I think it is incredibly important to demonstrate momentum. And I know we talked about this before, but too often I have founders that come to us and say, we just need to get some money, and then we're going to hire a CTO, and then we can build out the tech. if you're not demonstrating traction and momentum before you have a tech person on board, that's a lost opportunity. It shouldn't hinge on just having the perfect product. It needs to also show that you've thought through the business model, that you've talked to customers, that you're building for something that's useful, and people, have demonstrated that they want to pay for it. So I think that there are a lot of things that entrepreneurs can do, and I can tell you, one of the first companies we funded was a company called Hand Up, which is basically a crowdfunding platform for the homeless. So you as an individual can go and donate toward medical expenses, housing, clothing, etc., toward a home for a homeless or low-income individual. And when they came to us, they were just an idea. And obviously, it's an idea that captures the imagination. You want to help homeless individuals, this sounds great. But the woman didn't have anything, literally nothing. So when she came to interview for the Tumml program, she came back to us and said, hey, remember 3 weeks ago when I pitched you the idea? I came back, and my bigger platform, or the thing that I'm imagining, is a web-based portal that allows you to do X, Y, and Z. But you know what? Right now, I got a developer on board part-time, and he built out this SMS text messaging system. And so now you can text, and you can donate toward Roddy, who became homeless because he was a vet, whole story. And basically, she had built a working prototype that was very, kind of basic in 24 hours. And it was amazing to see that kind of progress. And so we took her into the program, and through the Tumml program, she actually launched a full pilot. She's since gone on to raise over $1.5 million and seen a lot of success. But it's early things like that that demonstrates so much momentum. And I think now there's been more people who are willing to take a risk, especially at the accelerator level and angel level. And certainly micro VCs are helping with that as well, and micro lenders.
I'm going to take one of the questions that were posted. What are some of the red flags that entrepreneurs should be aware of when accepting investment money? What should I look out for when drawing up a contract? Well, typically, most investors will have the contract that they give you versus you providing a contract. If for some reason, though, you're dealing with an angel investor, this is a time where a lawyer and an experienced startup lawyer is absolutely 150, 200% required. Because if this contract is not done right, if these agreements, whether it's a note or equity arrangement, if it's not done properly, this can completely affect your ability to raise more dollars down the line. So it's really important that you find the right support, and usually there's a lot of great startup lawyers out there who are very experienced in this area, and that's an investment 100% well spent. Because I do have had many deals fall apart at the point of looking at how the company was structured in terms of the valuation that was given to the company was too high to begin with, and the angel investor wouldn't come down, or they put in some very intensive, non-standard rights in terms of either board arrangements or what the discount percentage will be when they actually convert into equity in the company. There's a whole bunch of things that are pretty standard out there. If you go to the National Venture Capital Association website, they have standard term sheets for both notes and for equity, and you want to be somewhere in that range, right? And that's a really helpful place to start.
Thanks for your question. So when we think about urban-based businesses, we intentionally do not pre-prescribe verticals, meaning we don't say, hey, we're focusing on housing, transportation, and sustainability. And the reason for that is because so many of the entrepreneurs that we have seen, we could never have dreamed up. And it's amazing what an entrepreneur's passion, where it'll lead them. And those are the best kind of companies. And so we have broadly seen a bunch of different areas, whether it be transit, housing, workforce development, civic engagement, arts and culture. I could go through the whole thing, but I won't bore you all. But the importance is that they are making a real, tangible urban impact, and it's not just isolated to one community. We can see it grow from Detroit to Oakland to Richmond to San Francisco. It doesn't have to be a tier 1 city, a smaller city. It can be applicable in many places. And so I mentioned the homelessness example. We also work with a company called Valor Water Analytics, which is basically a big data platform for water utilities. And obviously it's a big issue now with the drought in California. So they come and they work with water utilities from across California to North Carolina and everywhere in between. And so we've seen a lot of folks trying to tackle different issues. We have had many of our entrepreneurs expand their services to Detroit, but we have not yet worked explicitly with somebody who was based in Detroit. And I would love to change that, which is why I'm here today.
All right, so Doug, I'm going to do the next question to you. How do you account for owner's equity? By the time they approach you, owner has spent a lot of both cash and sweat equity.
How do we account for owners' equity?
So I think just talking about how do we value and what goes into that valuation consideration.
Right, so when we're looking at making an investment, and I don't think we're non-standard in this way, as an investor, as a venture capital investor, we need to get certain ownership in the company. Now, we didn't talk about segmentation of venture capital. There's a whole different segmentations of venture capital, from micro VCs and early stage venture capitalists like us to later stage growth capital, mezzanine, and private equity investors. And they all have different amounts of capital they'll put in, and they went up that stack, usually larger amounts. And they also have very specific sectors. Sometimes you were asking earlier about investors wanting to see traction. Well, you may be talking to the wrong person in the stack, right? There are early stage investors that follow and want to see how somebody else lead, and then there's lead investors who like to be the first money in. We happen to be a lead investor. We like to be first. So it depends who you talk to. When it comes to ownership, most rounds of venture capital, you're going to look to give up between 20 and 30% of your company, right? In private equity and later on, there's different types of investing where they actually try to get control of the company, but not in venture. It's typically 20 to 30%. The value of the founder's equity is really important. And it's not our goal to have the founder not motivated, because if the founder is not motivated, they don't have enough equity. They're not going to work to make this a success. And without the founders, we have nothing to invest in. We need them to be driving the culture of the company. So there is a dilution, but it's a negotiation that happens, and it's a balance of several topics. It's how much money do you need to raise, how much ownership are you willing to give up, and how much ownership does the investors need. And those three factors all work together to determine a valuation. We put a high value on sweat equity, and we've all been there as entrepreneurs. We know how hard it is to go from nothing to something. It's really, really hard. We get that. And so we try to be fair and make sure we reward the entrepreneurs and not do things that are onerous in the term sheets Patty was talking about. There's a great book by Brad Feld, by the way, called, I think it's Be Smarter Than Your Venture Capitalist and Lawyer, right? It's a great book. And it talks all about standard term sheets and what's kind of normal in raising capital.
The other thing that we've seen, and I think it's really important, getting the money is important, but who you get it from is more important. Absolutely. You've got to have an angel investor or a VC who can help you. I'm thinking specifically of the First Step Fund, where they can put $50,000 in, but they also stick with the company and can move them on to the next level if necessary. I've always said that for us, and by the way, 90% of the companies in our portfolio are companies that could not get a bank loan. But for us, putting the money in is the easier part. It's what we do before and afterwards that really is important. And when you've got an investor in your company, just be sure they can be of some help to you and help you move up that ladder.
Yeah, that partnership is really important. And something else that you also are seeing across this panel, we all have different funds or different types of programs that we run. And before you ever even go in for a pitch or go in to try to seek funding, you really want to understand the unique kind of the differences of the groups that you're going in to see, because we're all different. And that's the same across the board. There are very few cookie cutter funds out there or groups that are funding organizations. So really make sure you know who you're talking to and what's important to them. So I'm really a big fan of customer discovery. Doug and I are both national I-Corps instructors. And having seen that ability to go out and really, have you talked to over 100 potential customers? Do you know your ecosystem? Do you know who's going to pay? Do you know what the barriers are? I've become a real fan of that model in terms of hey, you need to understand what the marketplace is telling you before you invest a lot of money in your tech.
I'm a big fan of doing stuff. I think that is the most important thing.
Yeah, there's two words somebody mentioned, or there's two words that come to mind that when we talk about entrepreneurship that should not be in your vocabulary. That's waiting and hope. It's do. That's the only word. Do. Right? To your point, right? It's really about movement and action.
I typically do not touch companies that have gone through a broker, and that's pretty standard with venture. We look for companies who are able to go out and sell their business to us directly. So if you go through an investment bank, you do have to get that filing, and also some of the crowdfunding stuff, you have to do that as well. But we typically just go straight with the company.
We did have a company go through it. I don't think they actually ended up getting any non-accredited investors, so I don't think that it was a real headache that they went through, and ultimately the people that they ended up getting money from were accredited anyway. So just thinking through your investment pipeline, if you're going after angels and micro VCs, I would just tell you to stick with the ones that know what's up, because they're the ones that are more likely to actually write the check. Well, I guess my question is, do you think that there needs to be a Kickstarter specifically for the Detroit community? And if you think this is a gap in the market, you should test it, and maybe you should start it.
No, I think there are a couple Detroit-based crowdfunding groups. Launch Good, which is more Islamic related, but also Patronet City.
And Kiva's probably done, this may be a slight guess on my part, but I'll be fairly close. 35 companies with their small loans here in the city from people that have put money into Kiva to put into companies. I think April Boyle at Build is now in charge of that program.
Yeah, and April's here today, so you can, I think she's on the other panel, but she'll be coming back in probably for the next conference.
Actually, quick plug, one of the entrepreneurs we supported in the Tumml cohort is a company called Neighborly, and they were actually doing crowdfunding in your community, and they've actually pivoted since then to crowd invest in municipal bonds, so you can choose to invest dollars in your community.
From a lending standpoint, it is a little difficult for us because we're looking at a company that's owned by a Canadian citizen at the moment here in Detroit. But to collateralize it with a personal guarantee for us is difficult with a Canadian citizen. But there are programs out there for microloans in addition to the collaborative. One is run by Prosper Us, which is really designed for neighborhood lending and immigrant lending. But I can't be specific about venture capital funds. That's the only issue with the loan, is how do we collateralize it and how do we collateralize the personal guarantee.
Yeah, we had one of our companies recently was getting ready to take on $1 million+ investment, and there were some visa issues. So, in terms of, certainly can you invest in someone who's not a U.S. citizen? Absolutely. But again, it depends on the fund and it depends on where the money's coming from. But we did have to get immigration lawyers involved, make sure that we had all the paperwork set up and that the person actually could be in the country for a couple of years legally to grow their business. So it comes up more from making sure that all the documentation is set up, and again, where's the source of funds and what are their requirements.
Yeah, I just underscore that. We worked with a lot of students at U of M that were not U.S. citizens that wanted to start companies. It's a source of frustration for me because we don't make this easier. Many of the very successful tech companies in Silicon Valley were started by non-U.S. citizens, and it's a huge job growth opportunity for our country, and we really make it hard. As an entrepreneur, you need to be very careful and get yourself an immigration lawyer, because we've seen people incorporate that weren't U.S. citizens and jeopardize their visa, and so it's bad news if you do it wrong. And so it's less from, is it an attractive investment for us to, there's certain things that have to happen, and you have to protect yourself. And then as long as you're protected and it's legally an entity formed, it's not a problem. In fact, many foreign entrepreneurs are much more successul than non-foreign. They just, statistically, it's a very interesting fact.
Yeah, I think over 15 to 20% of our portfolio is immigrant based. So. I think we have time for 30 seconds for one more question. So I would use the community development services versus online tools. Now, and maybe there's some folks that know about things that are really good out there, but using the Sparks and the Tech Towns, the Small Business Development Corporation, the state has lots of resources to help businesses, startup businesses, get those items together. We all have different views on what's important to us. Like I won't read a 10-page business plan. I look more for the pitch and just the high-level information, but everybody's different, and so use the community support infrastructure versus, I don't know of an online platform that helps you put that together.
Yep, I think it's much more about substance than form in this case, honestly. I'd rather see a stack of paper in front of me with all this data collected from the 1,000 or 100 people you've talked to and what you learned than a beautiful pitch, honestly, right? It's about substance.
All right, and unfortunately, I think we have to wrap up. It's 3:25, so I think we're moving to break, and then we're coming back for the next session. All right, thank you all.
Thank you.
Appreciate
Thank you.
So they put this in Kickstarter, and they were able to raise $33,000, right? And so the idea is that they are the Airbnb of storefronts. So basically, they have storefronts, and they have business owners that need